Global financial markets are constantly evolving. New financial instruments represent both an opportunity for innovation and development and also a challenge for financial regulation and integration initiatives. The cross border payment industry is no different. With the introduction of decentralized finance as an alternative to traditional money operations. Studying the cross border payments industry, especially remittances, is highly relevant in today's world since this instrument directly contributes to poverty reduction, increased consumption, and greater access to education, healthcare, and housing. During the last decades, the analysis of remittances has experienced renewed interest given the significant increase of global intermobility and the sheer volume of transactions. In Nicaragua, remittances amounted to $5.2 billion in 2024, representing a 13% increase year over year and an astounding 362% increase in the past decade. Not only does this instrument show rapid growth, when factoring a GDP of $19.69 billion for the same year, it is unquestionable remittances play a key role in the national economy as a catalyst for sustainability by incentivizing consumption and store value, and as a profitable business product for financial institutions.
Digital currencies are an increasingly relevant topic worldwide as it rapidly becomes apparent that innovation is growing at a faster rate than the legal and business infrastructure. By studying market trends and lessons in similar countries, the study can assess the impact of introducing stablecoins in Nicaragua. With the discussion centered around the speed, reliability, and transparency stablecoins could potentially present when compared to traditional payment rails, the following study asked the question: can stablecoins be integrated as a remittance instrument in Nicaragua? And if so, is the compliance and governance architecture ready for this innovation? What would the rate of acceptance be, and who will benefit from a financial inclusion standpoint? For this study, data was collected through surveys to randomly selected citizens of Managua, Nicaragua. Results from survey were later evaluated using descriptive analytics to find central tendencies. Design, database storage, ETL process, and data visualization were all performed using state-of-the-art, industry-leading software. This was later complemented by introducing a natural language processing tool, which provides a synopsis of unstructured data in pieces of text to create a concise, coherent summary of responses' main points. Even though the vast majority don't have previous experience with digital currencies, almost half the respondents would like to try stablecoins in the future. The gap between willingness and experience shows the potential for adoption of this instrument in Nicaragua and hints a clear demand for innovation in the financial sector. The high access to banking shows the trust or dependency in traditional payment rails. An assumption could be made that contestants have yet to experience decentralized finance due to the lack of options available in the portfolio of national financial institutions, and also that if these institutions were to partner with stablecoin products, the market will be receptive to it with a great speed of inclusion. From this perspective, stablecoins will not substitute the current financial ecosystem. Rather, it will be introduced as an enabler for diversification and access to new opportunities, connecting local wallets to international markets. Especially referring to stablecoins as a remittance instrument, the survey participants highlighted receiving remittances as their preferred use of digital currency, backed by the General Association of Stablecoins with faster transfers, low commissions, and an inflation shield from local currency disparities. Those benefits combined, plus the high acceptance of stablecoins as savings mechanism, reflect a scenario in which stablecoin receivers will obtain and hold value in the medium to long term rather than racing to liquidate, while maximizing transfer values. Stablecoin adoption could serve as a financial inclusion tool. This is backed by literature studies, which have found elasticity between the cost of remitting and the number of transactions. By decreasing the cost of remittances by 1%, transactions could increase up to 2.1%. Because remittances are tied with income inequality, it is concluded that stablecoin integration would positively impact the economy and the distribution of resources in the economy. Stablecoins are viewed as a remittance instrument, but not as a bidirectional money movement tool. This hinders the impact of stablecoins, although slightly, as Nicaragua is commonly denoted as a receiving country. This also outlines money movement perception and the notions of risk. It is easier to accept stablecoins when the duty of due diligence, KYC, compliance, and risk-taking falls under the person in the developed country. Or rather, it is easier to accept stablecoins when operations come from a trusted source first, like relatives and friends, before slowly trusting operations that require personal action. It is implied survey participants are eager to receive, test, and retain stablecoins, but not exercise trigger operations until digital currencies prove their usefulness and guarantees. The results from the open question show participants have confidence in digital currencies being accepted and becoming a popular instrument when weighting their benefits and assuming a satisfactory implementation. However, they also highlight the need for previous education and training. The main concerns gathered from results are the possibility of fraud, lack of financial protection, and the overall economic stability of the country. It is not explicit, but most concerns can be avoided with appropriate government intervention by establishing regulations that govern the digital currency ecosystem and promote high-value coins like Tether or USDC, backed by credible companies with a high share of the global market. The most surprising finding from the open question and from the survey overall is what was not found. None of the participants highlighted the potential difficulties of liquidity. In a scenario where stablecoins are adopted faster than regulation can be approved, converting stablecoins to dollars or Nicaraguan cordobas in the territory would be a great endeavor, basically reducing stablecoins to a shadow banking system. It is again spotlighted the importance of the government acceptance of financial innovation while maintaining an inclusive environment for the development of digital currencies, including stablecoins. As with any emerging technology or product, the road to stablecoins is one filled with uncertainty and change, accentuated in a global market characterized by the fast-moving nature of innovation and the lagging of regulation. Findings serve to rethink stablecoin landscape in Nicaragua. Users are eager to test new financial instruments and hold medium to long-term positions with stablecoin currencies, rather than initial hypotheses of short-term solutions to bypass the higher banking fees. It is also concluded that stablecoins will better penetrate the Nicaraguan market if backed by the traditional banking system, making it an extension of the current ecosystem rather than a disruptor of the zeitgeist. This also connects with the lack of liquidity concerns from survey participants. It is theorized that the lack of concern comes from an implicit assumption that financial innovation will come from the traditional banking sector. The initial hypothesis of stablecoins serving as a remittance instrument in Nicaragua and a medium for financial inclusion are both backed by findings from literature and perceptions by survey participants. Stablecoins will not go beyond remittance towards a cross-border, bidirectional money movement tool unless protection and legal certainty is demonstrated, along with a frictionless user experience that meets customer needs. To most, adopting stablecoins as a remittance instrument may seem sufficient, given Nicaragua's net position as a receiving country in the industry, yet it would be a missed opportunity not to envision a future where average citizens can access international markets from the palm of their hands. Finally, no successful stablecoin adoption would be achieved unless backed by government regulation and active promotion, guided by international standards and best market practices. Security and trust are at the forefront of consumers' concerns, and the ability of central banks and regulators to efficiently approach these concerns greatly correlates with the health of the ecosystem.